Well, good morning, all. We're here again on our typical Friday as the Consulting Amigos, and we're doing this, of course, for the MicroGiant group and a lot of other people those of you who have subscribed and view us on a regular basis. And we thank you for being here. Today we've got our regular panel, uh, John Mills, Ed Lasak, and Ray Anderson. Um, we're going to talk a little bit today about selling your business. And I'm going to lead in on that by kind of reading a little something that I managed to pull up, just kind of the stats right now. A significant number of business owners are expected to retire in the next 5 years, leading to the sale or closure of their business. According to a 2023 report by the Exit Planning Institute, 57% of baby boomer business owners plan to exit their business within this time frame, given that baby boomers own approximately 2.3 million small businesses in the U.S., employing about 25 million people. This trend could be a substantial impact on the workforce. Ray, you've been kind of pounding us with that for, I don't know, 5 or 10 years, and it's upon us now. However, many of these businesses face challenges during the transition. Studies indicate that only 20 to 30% of small businesses listed for sale actually find buyers, and that leaves the majority without a clear succession plan. It underscores the importance for business owners to develop comprehensive exit strategies to ensure the continuity of their enterprises and preservation of associated jobs. And of course, Ed Lasak is a guy who's kind of specialized in this for some time, and we're going to have him lead off with a couple of with discussion. And we've got a couple of slides that we're going to pull up and kind of bring you guys along with us on the discussion. Okay, so Ed, when you can see that, go ahead and take it away.
Well, thank you, Ron. One of the things that really is disappointing to me is when I get a call from someone saying, well, I got some bad news and or my business isn't doing well and I need to get out of it right now. And these are people that I've been talking to over the years, and they never have any time to talk about exit strategies. And then all of a sudden, we all find out that we are going to exit our businesses with or without a plan. It's just going to happen. We may think, we kind of look at the recent past and say, well, we assume we're going to have a future. We're a certain age, and the average age is such and such, so we have so many years left. Well, that isn't the way it works, unfortunately. And you have to have a plan in place because there are a lot of people depending upon your business. You have, most importantly, the employees who have helped your business get to where it's at. And without an exit plan, they don't have a secure retirement in front of them. So that's really important. But one thing that's probably never mentioned are the customers, and the customers are relying upon your business to provide them with services or products that they need to do business. And they're just assuming you're going to be around and you've done your job, your due diligence to find an option to keep the company going. And sometimes they're surprised, and then they have to scurry around and try to find some type of an option to make up for your loss of expertise. So that's really important. And I don't understand why people don't make the time to really look into this, especially as part of their estate plan. I think most people spend time on their estate to have some type of documentation in place for the future. But a lot of times the businesses aren't included. And I think part of that has to do with their trusted advisors many times don't have the experience or the training to help them make this a priority so that they're planning for their futures. So anyway, I think what I'd like to do in this episode is just to kick it around a little bit and try to find out from different perspectives what some of these options are popular, which ones aren't, and get some real life perspectives from the panel on their thinking. So to start it off, I'd like to chat a little bit about the exit options. I come up with 6. There's a lot more if you really want to get into all the specialization, but I come up with 6. And the first one is a family transfer. And that seems to be the most popular. It just seems to make sense. You're going to transfer the business to the next generation. But we all know that always doesn't work. Many times it doesn't work, in fact.
Yeah.
And challenging family dynamics makes it really, really difficult to make this option work. Another option is the management buyout. That's a great one because you have the expertise in place, but unfortunately the money isn't there. And many times people aren't interested in running a company and owning a company. They don't mind working at a company, but they really don't want to own the company. The third option I have here is some type of a partner buyout. And if you find the right partner, that's a great option, but it is a challenge to find someone that's compatible with you and has expertise that can add to the business. And the fourth option is a third-party sale, which happens quite frequently, either to a strategic buyer who is in your business that wants to take your business and combine them with theirs to come up with synergies, or a financial buyer who just wants to take your business and grow it to the next step. And the fifth one is an ESOP, and that's an employee stock ownership plan. I've been really getting into this one recently. I have some clients that are going through the process. This one really has a lot of benefits to companies that are making $1.5 million and above, something that they don't really understand. Many people don't understand or aren't planning properly for it, but it's a great option. And the last option I call the Ron Burgess option was liquidation. Ron had a wonderful marketing company, but for the most part, Ron decided that it was probably in his best interest, for whatever reason, to just liquidate the company and or use it in some type of a minor way than what it was used before. And that seems to be the most popular option. As we all know, we hear it all the time. 70% of the businesses put up for sale don't sell. And so anyway, they end up with liquidation on pennies of the dollar. So I'd like to open it up to the panel now to discuss some of these options. What do you think? Why people don't have a plan in place? And what do you think about these 6 options I have on the screen?
Well, I'd like to suggest perhaps adding one, which I know you've thought about, but maybe just haven't broken down, because it could be part of any one of these. And that option would be giving away or gifting a chunk of their business and or other options with it, and why that may be applicable in some instances. Because I think from a tax perspective, that could be a very applicable one in some instances. My comment on why people don't do this is exactly the same reason. For me, it seems why some companies don't have adequate insurance and board of directors insurance, key person insurance. I think the companies that don't have key party insurance and planning also typically, I think, would be those companies who don't think about or don't put into plans any exit strategy. And going along with that is the very worst time to sell your company is, of course, when you need to sell your company. I mean, that's just, it's a foregone. The very best time to sell it is when things are going extremely well and, it looks good. And why would you sell it? Because everything is going well. And I think we just procrastinate it because I don't think we actually think we're ever going to sell the company that we invested in and started up. I think it's just a core part of our human nature. So that's my opening comment.
Excellent. Ray, what do you think?
Well, I was just while you were talking about this, I wanted to get a kind of a sense for among us baby boomers what the number of people who actually have a succession plan. And according to Price Waterhouse Coopers, only 15% of baby boomers have a documented exit plan. And that certainly speaks to my experience of my own business. And as you were just pointing out for Ron's, it's not particularly easy. And I think the smaller the business, the more of a challenge it is, because nobody's going to buy a business that's simply going to be a job. In other words, it's going to replace their income with a similar income.
Yeah, right. And in partial defense of the Ron Burgess plan, number 6 there, I did, we really have phased out of that business. And we sold a piece of our business in terms of sold our clients. That happened to be the part that was the website part of the business. And we did just sell it outright for a pretty good deal for the buyer and an okay deal for us, because the truth is that you have to earn your you have to earn your money every week, every day, every month. You still have to do something in order to, and in this particular case, there was no assurance that we were going to have ongoing business from a wide variety. And I think we sold some 500, 400 clients, something like that. Kept a few of them. And then the second piece is that kind of goes along with what John had just said, is that with 2 employees that we have left, we're probably they're still going to have a job when I'm done, and because the client will want to keep them, so we're just going to give it to them. That's the plan now, is to give it to them. So instead of a retirement plan, I mean, of course, we do have 401k set up and we have all of that kind of stuff, but really their loyalty has been great. I mean, it's close to 20 years in this particular case. It's like they deserve to get something as opposed to just nothing. And so we're probably just going to say, look, you can work directly for the client now. You know well what you're doing. The client loves the individuals, and so it's like, you can take it. They're gonna end up increasing their hourly rates. They'll make more money. The client will save a little money, and it'll be good for all around. And it's not like there's not value there. There would be some value, but it's not enough value for me to worry about. It's not going to mean I'm going to be a lot richer. It doesn't mean that it's completing my retirement plan. It's like that stuff's all over and done anyway, and it's just not enough money to matter to me. But it's something substantial for them. So
Ron, if I could jump in on that, because I think I did the similar thing in a business. We were in the engineering, electronics business and sales business. And what you're describing is a relationship-centric business that you also have a very good business background in. So in our case, we had 4 or 5 people that had worked. 2 of them had worked for a period of 15 years and were an integral part of the management team. And then when I decided to move on, they were not in a position financially to start up and try to go and engineer it from start. But I was in a position where I could basically give them a third of our manufacturers with agreement from the manufacturers. So the dialogue was, look, here's what's going on. I'm stepping out, but these guys have been doing the majority of the heavy lifting. Let's see if we can restructure it so it just transfers over with no hiccups, and a complete compliance, willing, and I'm still there to help them. They're here to help me. And that was a wonderful thing. No money transferred our back pockets, just a good relationship.
Yeah.
And a variation of that in the same transaction, we had one individual who had been with us a shorter period of time, but he was starting his own competitive line of business. And so I approached him one day and I said, look, I tell you what, say we give you a third of the business that is highly suitable for the business you're starting. It fit right in with his core competence. And I said, here's the deal. For the first, let's make it the cost of it will be the full income for a year. But what we'll do is we'll have me pay you 50% of the commissions for the first 3 months, and then we'll transfer it, and you can pay me for the second 3 months. And so at the end of it, I end up getting, well, 2 years, I end up getting 100% of the commissions for 1 year. You just pay for it over a period of 2 years. And it was twice as much money as he was getting. So he agreed to it on the day. I wrote him a check, I think, for $7,000 or $8,000 35 years ago for that month. And he was extremely happy because he was basically coming from a break-even standpoint of trying to create his own business. And all of a sudden he had $4 or $5 grand a month coming in, and he could grow it and add it to him. It worked out to be a win-win for him. He was very, very appreciative. And it was a win-win for me because I trusted him. And he ended up paying me out over the course of that year. So it's a variation of that relationship-centric, trustworthy business.
I would respond to that by saying those are really good examples, and I would classify that more as a planned liquidation option. And that's a very good approach also. Like Ron said, if there aren't significant assets, a planned approach where in Ron's case, he took care of his employees that have made the business, which was wonderful, and then has helped his clients, his customers transition to another service. That's a very responsible way of liquidating your business. And it's a worthwhile option. But again, there's a plan. It's not something that you find out one day you got a problem and you got to get out of the business the next day. That's kind of without a plan. That is kind of what you want to avoid.
Yeah, and truly, I think this process has been going on for maybe almost 7 years now. So it's not like it happens really fast. We got to the point where with a particular client, the one client that I still work directly with, to where they wanted a guarantee from me to how long I'd be there. And I said to them, this is 6 months ago, and I said, well, I'll give you 2 years. And they were highly relieved. I'm glad to say that's pretty nice to be an old duffer and have somebody say, we don't want you leaving right away.
Yeah.
So that's terrific right there. But we're going to take this 2 years to do a transition, is to partially, I'm leaving them with a 5-year plan. They have an internal person that they're going to train, that we've been training for the last year and a half. And then, of course, with the other 2 employees, they'll still have a complete team to do almost everything that I did. And of course, they'll have a 5-year plan, which is what I do. So the strategic side of it, we're going through now, and it'll be in action by the time I'm actually done. So the hope is to really leave them whole. Yeah.
Excellent.
No, and I think it's good that both of you mentioned the gifting part of this that Ed, you hadn't included, and it really demonstrates that that's an excellent way of being able to transition the business, keep it moving forward, and still help create some income for the owner.
So that's kind of like a version of 2, kind of expertise, but they don't really have the money. And in this particular case, it's like, would they pay for it? I don't know. If I asked them to, and I showed them how it would benefit them, they might. But I don't know, it just kind of left that it leaves a bad taste in my mouth. And it's because it's really not that much. It might be significant for them. And I think, John, you mentioned, there might actually be some tax benefits. Is there, Ed, is there a tax benefit to gifting my business to somebody?
Yeah, and estate planning, gifting is a big part of it, and it is a way of minimizing your taxes down the road. But I think if you gift it or sell it, no matter what, you got to have the team in place to run it without you.
Yeah.
And that really becomes the challenge, I think, which we'll get into a little bit more detail in the next slide.
Yeah. Okay. Ready to go to the next slide then?
Yeah.
Okay, there we go.
So what do you do now? You're listening to this program and you're probably tired of hearing about it and everybody's telling you have to have a plan. And well, I really believe you need to get started and you got to stop waiting and you got to realize we don't know what's going to happen to us in the future. And we have to have the business prepared to continue without us. So we need a plan. So how do you start doing that? What's your first steps in making that happen? And I really think the first step, the most important one, is to make your exit plan a priority. Find the time to start spending on it. Number two gets into engaging trusted advisors to begin the process. It always helps when you have a group like this panel involved to give you different perspectives and different inputs so that you're well versed on all the different options and how it's going to affect you. And you got to be careful because a lot of the traditional advisors that you're utilizing, they aren't experts in this area. They're not involved with selling businesses or thinking about the next option for you, such as an ESOP plan. You need to bring that expertise into your inner circle. It's people that you trust. It doesn't cost a lot of money to do this. It just requires some time, which means you got to have your support people running the business without you having to be involved 24/7 in making every decision in the business. And I think you need to have legal advice, financial advice, and operators, because one of the things we're going to do is to consider how to run the business more effectively. So find time to start understanding the options, start modeling them. Remember, as John indicated at the beginning of this presentation, things change. One option today might not be the ultimate option for you down the road. But if you understand your different options, you're better suited to be able to handle any types of differences that come up down the road. You got to understand the tax implications. That's been mentioned already, and they're very complicated. And believe it or not, it starts with what corporate structure that you have in place. For the most part, S corporations are preferable over C corporations, for instance. Very detailed explanations as to why that's not the purpose of this get together. But it is something you have to be able to fully understand, because some of the options you might get the best price for your business, but when you consider all the tax implications, it might be the worst option for you, because you really want to know what you're netting, what you're putting in your pocket, not so much what you're selling it for. And the tax rates, especially when you consider the California state income tax rates, really make a big difference. And so therefore, you got to understand the net value of what you put in your pocket. You got to develop and incent your management team to run the company without you. Ray's got a lot of experience in this, and he needs to be fully involved with your management team and you and the business owner, trying to get the business owner to give up these daily responsibilities. And the other thing is incenting your management team. A lot of times you give them responsibility, but there's no upside for them to be doing their job. And that's all very important to this process. You want it to be a win-win. The more you grow the company, the more your management team has to the ability to make an incentives. It all starts with a valuation process, and it's more than just knowing the number. It's understanding how business are valuated for tax reasons and for any other reason that could come up, because that process will give you insights on how to increase the value of the company. And that is the ultimate during the 2 or 3 years that you're planning for your exit. You need to be building the value of the company based upon your strategic vision and strategic issues and objectives so that you're moving forward and increasing the value of the company each and every year, which means for the most part, you're taking care of your customers because we all know customers are the lifeline of our businesses. So, what did I miss, guys? What do you think?
Well, I always come back to people. As you know, one of the things I think fairly easy to start off with is I think you should look at the whole scope of these options and rule out the ones that you feel are just not going to happen. For example, in my current business, an ESOP is not going to be one of the options that I could play with because our relative income and the number of employees, we've got a very low employee business with intent. So that's not going to work. The partner buyout, I don't have any partners. So that's not going to work. So I can rule those out. And then you come down to the other couple of options. The most difficult one, I think, to evaluate is family transfer. Because a lot of people have in their mind the thought that this will be something nice that one of the family members would like to take over. And I would say in the majority of those cases, it's a one-sided dream and it really doesn't fit extremely well with your family members.
You're
And a
talking
classic
about
example,
that's the business owner side's dream, right?
right? It's the business.
Yeah.
I
Yeah,
mean,
that's right.
and I just came back from spending some time in New Zealand, and this is really prevalent in New Zealand right now, where a lot of farmers have their farm, and the thought is, boy, this would be great for my kids to pick up and carry on in farming. Except your kids have moved away to Australia, UK, America, and they don't want to go back to the farm. So, maybe they'd like to buy it and have somebody else run it, but as a lifestyle, it's not there. So that's a difficult one. And right along with the family transfer is even if you could engineer it appropriately, normally it would involve giving away a great deal of control and asset. And so that it's not going to be a very financially lucrative transition, but it may be good for the family member. The problem is, as I see it, and correct me if I'm wrong, gentlemen, is those ongoing communications and dialogues that now you're not free from that at Thanksgiving and Christmas. And it's, well, how are things going? Why? I'd hoped it would do a little bit better. The relationship breakdown, I think, is possible. And, maybe it's not the best thing for longevity of the family, love and good amicable behavior. I don't know. That's my thoughts.
Well, that's absolutely right. I mean, the family transfer is a really tough one, and we've mentioned before on this show that we've been through that a few times as a group and individually, and I've seen one very, very terrific one. And that was a transition that took about 7 or 8 years, and had the children came in for the third generation, and it was very, very well structured. And then, of course, there are others where you've got the family, and if the owner doesn't think this through carefully, the command and control doesn't work, because if you put several members on a board and they have an equal vote, you just end up with internal fighting, especially with different personalities, and those individuals have been sort of trained in one section of the business, and of course we all have certain capabilities that are different from each other, so that's just going to happen. That's hard. That is really hard, and it's a very special circumstance. Those businesses out there that are going to do that already know that they've got family who are interested, and they're going to do it. The real question is, how do you actually manage the family business? And we've done a couple tapings on that, and you can look through our channel and find some of those to have that discussion. I like the management buyout one, and you mentioned, or partner, and you mentioned, John, that you don't have a partner, but I think maybe this also means we'll look for one.
Exactly.
It's kind of like, okay, you're looking for people who can run your business so you can step back. but are you looking for people that would be good natural partners, that would make strong partners and actually buy out? Now, I don't know if you have, I'm sure it's crossed your mind. But that means giving something up. That means paying somebody a little bit more money to learn your business. And so by the time you get through with that, I don't know if you devalue the business enough to make a difference, but it'd be worth
Well, I actually
the
agree. I agree with
exercise.
you. I agree with you in that. And that is what you're saying is the work and the effort that you put in as the owner, founder of the business quite often is not that detailed, but it is there's a lot of knowledge that each of the business owners know about how relatively run their business.
Yeah.
There's nuance in there, which is hard to put in an SOP, although you can, and have somebody else learn. It's a lot about evaluation and customer relations and understanding how the difference between something that's urgent and something that's important and something that's critical. And for each of our businesses, that's different. But yes, to bring somebody alongside you and start to have them intern or follow you or shadow you in that process, and ultimately, hopefully, they would have the opportunity to pick up the day-to-day operations and then work into a management.
Yeah.
Yeah,
Right.
I totally agree.
This number four and let's say five and three, 4 and 5. Those I think, find an outside buyer or an ESOP. You mentioned $1.5 million. I think you're talking about that plus. To have a third party interested in buying a business, you have to find a partner effectively who can take your business over. It's in order to be able to sell to, say, an equity buyer, you got to have a much bigger business than that. How big do you think a business needs to be in order to be attractive to be bought out by a third party equity kind of organization? Is that a $5 million? Is it a 20
Well,
million?
it would be probably a $5 million. They'd be interested in 2 million of EBITDA
Mm-hmm.
profit. Yeah,
Oh, EBITDA, sure. Yeah.
the problem with that though is that you're giving up control of your company.
Yeah.
If you
But you're
nurture,
trying to sell it, right?
well, you're trying to sell it, but you don't want them to come in and fire all your employees, move it to a new location. Therefore, your legacy is gone. And I think the biggest aspect of all these options, in my opinion, is to take care of your employees. Your employees make your company run, and they have been there for you to help develop your company to where it's at today. And selling to a third party that is a private equity group that's going to just try to optimize the bottom line and all your employees could be at risk, to me, isn't an attractive option for me.
Well, I understand that, and I kind of agree with that myself as well. But it's also and you guys can pipe in. It feels to me like, business owners and the ones that I've watched, they get to a point to where, oh yeah, I'm gonna have to sell someday. I'm not ready now, et cetera. They don't really do the plan the way you have suggested, and suddenly they need to sell, and so they're in a place kind of where things are tough. It gets taken out of their hands. In other words, if they don't have a proactive way to do this, they end up losing the opportunity to keep those employees. Now, number one. Number two, if they think they're going to sell, or they're kind of plan it out a little bit, but haven't done a good job and really jumped in and spent the time and effort. I think an awful lot of these businesses are stale and old, just like the owners, just like us. You get stale and old and your business is not optimized. Who wants to buy that, you see?
Well, that's
So,
a good point, Ron. And
you
I
know,
think a lot of times when people start listing their business is already gone.
well, right. And
I
so,
think that's bringing up
you
your point.
you have to sell a business on its best day. And its best
Exactly.
its best
And-
day is when you've upgraded the systems, you're digital, you've got good people, you've got great HR systems and benefits, you've got everything really honed, so somebody could come in and say, this is a really good business. Boy, I don't think I would say I've had 5% of my clients maximum that have ever had an optimum year like that. How about you guys? You guys have, clients that really understand that and make it happen? It's hard. I just
Yeah, no, I think that's why only 15% ever get there, because basically, as we all, from personal experience, we all know that we're so busy with the day-to-day operations and never think about how to get out of running the business. And as a consequence, the business is us. And so it's such a big challenge that few people really can make the transition effectively.
yeah, I think you're exactly right there. And the name of the company is escaping me, but it's the second largest individual business company in the world. Coke, the Coke brothers, they've been famous and infamous, recently. The interesting part about what they have done over the years is that they never really got wedded to their business emotionally. They built a system of valuation that was simply based on the numbers. They wanted to be efficient in all the things that you do in order to be able to increase the valuation. They have kind of used a system similar to yours, Ed, where you've got your drivers that increase the value of the business. So if you're interested in selling at a good profit for yourself and you've done a nice job in building your equity, et cetera, you can do this. But their attitude was, when someone else will pay more for a business than we think it's worth, we will sell it to them.
Mhm.
Period. So
Yeah.
every single business that they had was big enough to have good managers. Number one, they knew that they owned these businesses, but they really were more like a board of directors running multiple businesses. So as they would buy a business, they would buy one big enough to be able to have good managers, and then they would oversee that and make sure they stayed that way. And then as they grew more and more businesses, and I don't know how many they have, dozens or hundreds of these, little, oil related businesses mostly, and chemical and so forth. And so they just basically said, look, we're going to sell. If you think that's worth that much money, we're willing to sell it to you because we don't see the value, there. You must know something we don't know. You must have another company that's symbiotic with this that makes the value to you higher than it is to us. So just sell it. Just sell it. It's like we're always for sale at the right price. Um, that's an emotional shift for most business people, especially the founders. It's like,
Yeah.
no, I built this because this is the way I wanted it to be, and somebody's going to come along and change it. Fine. Well, but you got to admit that's partially a hobby, okay? That's
Yeah.
not a business that is maximizing profit. That's not a business that is trying to build equity and wealth. That's a business that you're doing because you like it. Now, I'm guilty of that. I've had both kinds of businesses, and the reason I phased out with the latest couple of businesses is because I like it. But I built it as something I wanted to do. When I was in the retail business and manufacturing, I didn't do it because I loved it. I did it because I wanted to make money, you know? Different attitude, completely different attitude there.
One of the drivers that really can have a significant impact on the profitability of your company is seldom used by business owners, and that is knowing what's going on in the market and in your location and in related businesses, because you don't have time to do that. You're so focused on running your business, but there could be a lot of other businesses up for sale or opportunities for partnerships with other businesses that combined with your business could make your business much more profitable. And that's one thing you always got to be looking for. You got to know what your business is worth, like you're saying, Ron. And if someone comes in and gives you a phenomenal offer, you know it's a phenomenal offer and you got to seriously consider it. But by the same token, you also got to know what other companies are selling for. Who wants to get out of the business? They may have a tragedy in the family and they need to sell their business quickly. If you're not out there and if you don't have contacts and if you're not looking for these opportunities, you're not going to find them.
Well,
And you're
Yeah.
going to miss out.
that's excellent point, and I think it would be fair to say that the Koch brothers did that all their lives. That's exactly
Yes.
what they did. Yeah.
Yes, they know what's going on. They got their nose in under the tent and they know what their competitors are doing and anybody that they're working with because they're keeping track of what's going on in the market and in that industry.
Yeah. This has been a great discussion. Any parting words then for the boomer who's ready to sell his or her business?
Well, I would say start now, just put it on the table and talk to the parties and the stakeholders around you. Say, look, this is a dialogue which we're going to have ongoing. We're going to be looking at options. Welcome your input on it, but here are the 6 or 7 things that we think we could do. We're going to rule out some of them, and let's get some dialogue going. Let's get the team involved. You may find somebody who's associated, the business may be very interested to step up. And that's always a good thing. If not, you're certainly putting the family members on notice that this is something that you're dealing with. And they will voluntarily talk to you about it. You know what? Now's not the time. I'd love to be part of it, but I can't do this. And I think having that dialogue will help settle you down into making the plans and steadily working through them.
Great.
And I would add to that, you would also keep in mind to try to come up with a solution that it's going to reward your employees because your employees are running the business. And as we all know, without you, someone's got to run the business and someone's got to step up. So it's your management team and your employees. And they have to be part of this process. And also, I think it's important to let your customers know that there's a transition plan in place or you're working on one so that they don't have to worry if something happens to you. They know that your company is going to be handled properly and continue to give them the goods and services that they need to do their business.
Yeah, I'd be very careful of announcing something prior to having, some solid ideas on that. I'm just very
Yeah, I think
careful.
you want your plan done before you do that.
You want your plan in place before you, unless you've got a key customer who knows you well and you've got an intimate relationship with them, sure. But in general, no news in that area for me would be the better way of going until you know what you're doing, because it's going to shift.
Let me change that perspective a little bit and let's look at it this way. If I'm running a business, I want to know which of the vendors that I'm doing business with are going to be around.
Right.
So I would have that as one of my requirements for doing business with me. And I think that's really important in government work, especially. They want to know about the succession plans of your company.
Right.
So yeah, good point, John.
Ray, last word.
Yeah, no, I think the real challenge, as John pointed out, having the team be aware of what's going on, and then inviting them to participate in some meaningful way, so that, like you've done, Ron, give the people who've been there a long time a chance to take over and make something for themselves, because they've benefited from the long-term relationship that you established with them.
Okay, so I think the message here is get started and start right now.
Yeah.
Then come back to the video, look at the different bullet points, and go through the process. You'll be very happy you did. Thanks a lot. We will see you, gentlemen. Appreciate it. Great information from a lot of expertise over a lot of years. Thank you very much.
Thank you.
Thank you.